Perfect. Good afternoon, everyone. Thank you for being here today at this insightful seminar. First of all, I would like to thank all the speakers who have taken this time to join us for this event. And today we are particularly grateful to have a pool of experts combining deep knowledge of regulated sector, of the cost of capital calculation, and investors in this regulated sector. Before we get into the main discussion for today, let me provide a brief introduction on what is Utilitalia. Utilitalia is the Italian Utilities Association, and this seminar is organized together with its foundation called Utilitatis. So our primary focus in today's seminar is to explore the complex process of financing infrastructure and setting the cost of capital within an environment characterized by uncertainty. We aim to bridge the gap between theory and practice, shedding light on challenges, opportunities, and risks. More specifically, we will delving into subject through the lens of regulated utilities sector, analyzing how these dynamics shape the landscapes of our discussion. And this seminar aims to spotlight current and future market trends within the macroeconomic landscape, focusing on assessing the cost of capital that acknowledge the investments characteristics risks. Historically, the regulated infrastructure investments have yielded steady, predictable returns. And this is because of the regulation. So the regulatory approach helps to ensure stability and to attract in the sectors the investments, thanks to clear rules and predictable behaviors, basically. And this, through the years, has facilitated the access to capital markets, allowing the financing of the growing volumes of investments. However, in the last year, they now face the non-systematic risks, and in particular, two types of non-systematic risks. The first one, which is the economic risk tied to inflation growth, and more broadly, the macroeconomics risks scenario. And secondly, the risks associated with the extreme events caused by the climate change. Infrastructure investments in general play a crucial role in mitigating and adapting to the climate change. And in particular, one sector among the infrastructure, which is particularly important with this regard, which is the water sector, And in Italy, in particular, we are in the next months in the launch of the new water tariff setting methods by the regulator, ARERA. And more specifically, within this period, the regulator will set the new cost of capital, which is the cost recognized in the allowed cost, ultimately, so the allowed cost for the tariff, the water tariff paid by the end users. The water sectors is also a great significance, mainly due to two aspects. First one is the water protection, the resource protection, which is very crucial for the climate change. In the last report of the IPCC, the Mediterranean area, and in particular the Italian peninsula, has been identified as a hotspot for the climate change. Moreover, Italy has a medium-high water exploitation index with respect to the other European countries. And this is very important and very surprisingly if we think that just a few years ago, 10 years ago, 15 years ago, the economic textbooks used the example of water as a good which was not considered an economic resource because it was not scarce. However, now the situation has changed, and it is now clear that water, along with all the other environmental resources, is indeed a limited resource. And this awareness necessitates a proper management into the conservation and the protection of this resource. The second reason why the water sector holds great significance is the need for investments for adaptation and mitigation of the climate change, and for the protection of the resource, which is mainly due to a proper infrastructure. We as Utilitalia have done an estimation on what is the annual sectoral requirements, which is estimated to be at least 6 billion euros per year. And this is just related to the civil use of water, which is roughly the 30% of the total end use of water. And these 6 billion euros are covered, are funded through a tariff for roughly 4 billions. For another billion are funded through the National Recovery and Resilience Plan until 2026. Afterwards, there will be over 2 billion euros per year in a steady state of additional need of investments, which represents an increase of 50% on an annual basis. So very relevant. I have highlighted the importance of water infrastructure, but another important infrastructure which is subject to change in the near future is already as subject to change is the gas network, because there is the actual risk that gas network become a stranded investments, and with this regard, European regulation and national regulation both play an important role in mitigate the stranded risk of the investment. So in this context, it is particularly important to promote actions that are aimed to enhance the industry's ability to advance and increasingly investment program, and an industry that is able to attract the suitable finance through that and equity. And it's really important to enhance actions that help industry to invest more by getting enough money and improving how they plan and do this consistently better. One key aspect in this slide is the cost of capital, which is the reflection of the investment's opportunity cost, and that is in this context need to be reassessed to have to ensure the proper return to the investors, to the lenders, and as well to the industry, in order to have the investments done and the infrastructure that are able to cope with these new challenges. Particularly the estimation of the cost of capital and of the parameters of the cost of capital that has to be based not only on the historical data but also on forward-looking data in order to have embedded the forward-looking values for the next regulatory period and for the next years and the next period. On this point, I pass the floor to Francesco Passo, who is principal Brattle Group and who is an expert of the regulated sectors and as well an expert of the cost of capital.
Thank you, Francesca, and thank you for Utilitatis to give me the opportunity to provide a helicopter view, let's say, on this approach, and then Bente, that is a colleague of mine from the US, is providing an international view too. And first of all, we have been dealing with cost of capital. I've been dealing with cost capital over the past 20 years across all regulated infrastructures. What is relevant is, in reality, that those infrastructures require a large capital investment, and once that you have made investment, the investment becomes stranded. So what is really relevant is to provide a proper cost of equity and cost of debt, but it's not only to the interest of the investors and also the debtors, but also to the interest of customers, because based on our experience, the wrong improper cost, a lower or a mistaken cost of capital implies delays in the CapEx plan, and this is detrimental to the consumers. So there is, I believe, a double approach that has to be seen. This is beneficial to the final consumers, and what matter is just to give the proper calculation. In terms of what we have seen, and this is important, is we have worked for the European Commission like 5-6 years ago on the fixed telecommunication industry, and that is where it was a report where we were saying there was a balance trade-off between long-term averages that provide stability and short-term numbers that are eventually subject to volatility. So the time that was before the quantitative easing, and there was a concern, and we were questioning if we were supposed to use, let's say, 5 years averages or maybe spot numbers or uplift and so forth. Here I'm just providing a little bit of a factual evidence that is a risk-free rate. You can see in the slide on the left side the rolling yields of the 10 years Italian Treasury bond, and also the one of the countries that are high-rated countries in Europe. And you can see that there has been a lot of volatility. There has been before the financial crisis in 2010, 2008, then there was the quantitative easing. But most importantly, you can see now that if you just look in, let's say, the numbers across the past 12 years, you get an average number that is low with respect to the actual numbers. On the right side, you can see also we have also a treasury bond that is in real terms because it's inflation linked. You can see also here that you have numbers that have increased, and also the forward-looking values are quite high. Please, next slide, if you don't mind. Okay. Next slide provides that one is just a country risk premium that also you can see there has been volatility, but while it was in the range of 1.2, 1.3, the spread between, let's say, the country's premium made this calculation of this difference between the yields of 10 years bonds of Italy and the high-rated European bonds. You can see now that it's quite high looking at the forward values. Next slide, please. And this is also an issue on the cost of debt. First of all, when we look in indexes at the iBox, you see also that is increasing over time. We can also elaborate, we can show that the iBox tends to be always a little bit lower than the cost of debt of Italian utilities. But even if there is this, let's say, undervalued value, the trend is quite clear. Next slide. And on the beta, and then Bente, it's my colleague, is going to elaborate more. It's quite important to see a rolling calculation of the beta over 5 years or over 2 years. You can see that the 5 years weekly averages are much more stable than the 2 years daily averages that have been quite low. So this is also something that has to be discussed, because given that we are facing a lot of non-systematic risk, the 5 years weekly data eventually might capture better this little bit some of this non-systematic risk. So this is the evidence. It's very clear that arithmetic averages long term give values that are quite low. I mean, we work, of course, we've done a lot of analysis on water, electricity and gas companies, but just I would like to mention something different, given that you know well the methodology that is applied by ARERA, or that also there is BEREC, no? That is the association of the telecom regulator that has applied so far 5 years averages, and now is pushing to something that is short term, average between long term and short term, and also with a forward-looking component, because they have understood that if you need to do investment in large infrastructures that is telecom, like NGN or others, you need to control for the fact that historical averages now are providing the present values. This is where, and then another issue, probably just like food for thought, is how can we manage that? Because probably there is probably, I think, a concern to apply higher values if regulators are afraid that interest rates might increase, or maybe it's also a concern to apply lower rates if they might increase. So the issue is eventually if you want to apply eventually short triggers to the values of the WACC in such a way that if there are some spreads that go above some thresholds, there might be an automatic adjustment. These apply values that are more close to the true market values, and eventually might be also to explain to regulators higher values. Hello? Can
Sorry,
you hear
Francesco, we didn't get the last bit. No.
Oh no,
sorry.
no. Last of the list, I think that we need to be sure that the calculation is made in a, let's say, transparent way, and not with discretionary top-ups or maybe discretionary calculations, because this is something that they are not appreciated. I leave the floor to Francesca, please, and Bente. Thank you.
Thank you, Francesco. To continue this discussion on the cost of capital, I will leave the floor to Bente Villadsen, who is principal at Brattle Group and an expert of the cost of capital. So Bente, please go ahead. Bente, sorry, we cannot hear you.
Can you see my screen?
Yes, we can see your screen.
Okay, excellent. So can you hear me now also?
And also you, yes.
Okay, so I was thinking I would take more of an international perspective. I have worked in all sectors of the regulated industry in North America, also in Australia and New Zealand, and some in the Caribbean and Mexico. So I have worked in many different places. So I thought I would take more of an international perspective on this. And particularly, I thought I would just very briefly introduce what is done in North America and then talk about some various issues. And they will be slightly different probably than what you see in Italy because certain things are not relevant. And then I might, if I have more time, talk a little bit about some incentives and other issues that has been done during the change of the economic conditions, especially in the industries as are. So first, a little bit about North American cost of capital regulation. Basically, it's a very large group of regulators you are facing because every state in North America, in the US, that is 50 states, and in Canada, it's 10 provinces, they all regulate the electric and gas and water utilities that operate within their state. So there's not one model. And the other thing that's important to understand is they have a very large degree of discretion. So it's not as if they pick one method and stick to it. What they all do is they say, well, we will hear evidence from the utilities, from anyone who has an interest in this topic, and from the regulator who might also hire an expert. And when they issue a final determination, they generally don't tell you exactly how they arrived at it. They will say, well, we looked at the evidence and we decided X. That's what they will do. So the other thing that might be different is they don't generally specify a WACC, they specify a return on equity and an equity percentage. And then they generally allow whatever cost of debt the utility actually faces. So that's typically how they do this. The other thing that I think is important, given your introductory remark, Francesca, is that what they do to encourage investments is oftentimes not to work with a return, but to work with an allowed equity percentage. So if you have a sector like the water sector in the US, where they want investments, they up the amount of equity they allow for the utility, and therefore automatically the return in that is upped because the cost of equity is higher than the cost of debt. The other thing I pulled out was sort of what the generally allowed return on equity and equity percentages are. And the first three are sort of the US. Canada does not really have much in terms of regulated water. They are mostly municipalities. But in the US, there's really not much of a difference in terms of what they allow for the return on equity. There is a difference in terms of what the equity percentage is, with water being the highest, because that's where the high investments is. The other thing that is important to note is that we do see a higher return in 23 than in 22, and higher in 22 than in 21. That has followed interest rates and inflation up, but not by nearly as much as you would expect if you had a systematic way of dealing with that. So some selected issues practices. The risk-free rate. Most North American regulators use a fairly short, relative to what we have seen other places, period to calculate it if they use a historical return. They typically use a very long-term government bond. It's not 10 years. It's in both the US, Canada, and Mexico, and also the Caribbean. They tend to look at 20 or 30-year bonds, very long horizon. There is a few who use 6 months, and that's by far the longest we see. Most use 90 days. Some use 30 days to calculate what it is, which means it's really up to date. And then there's a number that actually use forecasted interest rates to look at what will it be going forward. That has been important in the past. Currently, there's not much of a difference. Everything, both long-term and current, are between 4.5% and 5% for the risk-free rate in the US and Canada. And the other thing I would mention is that Many regulators allowed for some kind of normalization during the period of time when the federal government was really trying to spur investment, so interest rates was extremely low. So I understand that in Italy there's been a lower bound on what the risk-free rate can be. And in the US, they've done something similar where they normalized the risk-free rate when it dropped really low. So when it dropped below 1.5%, they tended to normalize it. My general philosophy is to look at a forward-looking risk-free rate that is applicable to the period of time where the estimated WACC will be in effect. I know that not every place might have reliable forecasts, but if such forecasts are reliable, you should look at those. Moving on to the equity risk premium. And there's several choices you can think about. You can look at a historical, forecasted, or surveys. And all of these, you have many choices to look at. But what I chose to focus on a little bit here was, what are we actually selecting if we are looking at an appropriate way of doing that? If we look at a historical, you could look at an arithmetic average. That's the long-term historical average, which is available for probably upwards 100 to 120 years. You can look at the geometric average, and I understand that both are assigned some weight in Italy. If we look at financial economics, they are very clear that it should be the arithmetic average that deserves by far the most weight, and you should use a very long horizon to determine it. In North America, we generally put all the weight on the arithmetic average. And if you look at, for example, what financial economics say is that, well, you could consider putting weight on it. But if, for example, you set weights for 3 years, and you have 120 years of data used, there should be a most 3 over 120 or 2.5% weight on the geometric average, and all the other weights should go to the arithmetic average. So that is the reason why in most of North America and also in New Zealand, for example, all the weight goes to the arithmetic average if they use that. There are some that also take a forward-looking perspective, most notably the U.S. Federal Energy Regulator, the FERC. They will say we use a forward-looking one, which is calculated using a discounted cash flow model. So that's forward-looking, and you only, of course, can look forward as far as you have forecast for growth. So that's what they will typically do. There are very few others that will do that, but most regulators will look at both the arithmetic and the discounted cash flow in North America and say, are they somewhat similar, or is there reasons to say that we may have a distortion? During the COVID period, for example, the discounted cash flow model clearly indicated that the historical average was very low. Currently, there's not much of a difference. The other issue, as Francesco said, I want to talk a little bit about is betas. And the standard in most of North America is to use 5-year weekly or sometimes 2 or 3 year weekly. And most of the time they use what they call the Bloom adjustment, which means they move it 1/3 towards 1. There has been a lot of discussion, especially in Canada, about the reasonableness of this, and especially the reasonableness of using weekly data and maybe even shorter or longer weekly data. What this chart shows is simply what does the errors, how are they distributed along the line? If you use on the left-hand side, you see 5 years of monthly betas, and you look at the very wide range. It's not very tight around the line, so it's not a very good estimate. And on the right-hand side, I looked at 3 years weekly, so that it wasn't too distorted in terms of the number of observations. And what you can see is clearly that you have a much tighter evidence. We have also looked at daily data, and a problem with daily data, at least in North America, is that we tend to get very different answers if we estimate it today and if we estimate it a year from now, and they tend to be highly volatile, which is a problem in regulation. So my personal view for North America has been that we go towards something that's more of a weekly, because it's somewhere in between. It provides some frequency and it does at the same time not have too much volatility. These charts are based on all regulated Canadian, US electric and gas utilities that has reasonable data and not has odd things. So in other words, if someone went into bankruptcy, I took them out. And the other thing I wanted to show was what has happened to betas. And we saw from Francesco before that betas actually moved around COVID. And we really saw that in the US too. So again, here the blue line is 5-year monthly data. The grayish line is 3-year weekly data. And then I put the confidence intervals, the 95% confidence interval around them. So there really was a spike towards the end of, exactly at the end of 2019, right as coincided with COVID. And what is actually interesting is that even after COVID has sort of subsided, which is the very right-hand point of the top chart, it actually is still very high. So that leads me to think that I'm not sure if it's just a COVID phenomenon or if it's a change in the industry. It's probably too early to tell. The other thing that I find stunning is here that if you look at the top chart and look back to, for example, 2007, 2008, we see the same high betas. So it's not as if it's unique. It's a little bit higher, but it's not unique in terms of what it is. Lastly, I want to talk a little bit about some selected issues and practices. First, selecting the WACC or the ROE. An interesting standard that comes from New Zealand is that they calculate the WACC using the capital asset pricing model and using a forecasted cost of debt. And then they try to determine what is the percentiles around that WACC. And they choose the 65 percentile. And they do that because they think it's worse to have a WACC that's too low than one that's a bit too high. So they consistently choose the 65 percentile. There has, in the past, they used the 75 percentile. They have reduced that to the 65 percentile. What does the US Federal Energy Regulatory Commission do? Well, they choose the median of the capital asset, the average of the medians of the capital asset pricing model as they estimate and the discounted cash flow. But there are cases where they'll choose what is actually again in the upper 1/3, which is again the 67 percentile. They do that if the entity is more risky than what we're used to estimate it, or if capital markets are highly volatile. The other thing they will do, and some state regulators will also do, is they add incentives to the allowed return on equity for selected issues that the regulator wants to accomplish. That is in the case of the Federal Energy Regulatory Commission, if you can relieve transmission constraints, which is a huge problem, if you can enhance the technology, or if you participate in certain market organizations, which again enhance the flow of power. I also, because I know that there's a water utility issue coming up, looked a little bit at the US water system. And one of the things that they look to is, well, they are wanting large investor-owned water utilities to take on smaller water utilities for the reason that they need a lot of investments that typically the small water utilities do not have. So what they will do is in Connecticut, for example, they will add an incentive to the allowed return at 0.5% to the return on equity if you take on some smaller utilities that they want you to do. And there's other mechanisms in, for example, Pennsylvania, where they allowed the standard calculated WACC on the purchase price, which is typically way higher than what you have actually invested in the assets. And then there's mechanisms that allows the flow of investments in such systems into the regulated asset base without awaiting a regulatory hearing, which is the common practice in those states. So there's incentives here to try to get investments into that water system. The last thing I talked a little bit about was stranded assets and asymmetric risk. And again, I heard Francesca talk about that. So they have early retirement of what we call carbon intensive assets. In the US, that's mostly coal plants. So what they have done is they add what they call securitization. So it's securitized, the utility gets whatever money is left invested and not yet depreciated in the asset. And in turn, you have a line item on the customer bills that will cover the remaining costs. And that flows straight then to a financial institution that agrees to finance this. The other thing they have done in some instances where they plan a retirement is to reduce the horizon of the depreciation, so you depreciate faster than you otherwise would. And the last thing I thought I would talk a little bit about is asymmetric risk. For example, wildfires. There's really no upside on wildfires. There's only downsides. So due to the regulation, you really can't realize much of an upside, but you can realize heavy downside. And in some instances, like for example, wildfires in the US West, you really can't even insure against it because no insurance company will take that on. So that means that in expectations, the utility will not be allowed to earn its required, its allowed WACC. It will be below that. So what you can do as a regulator is to remove the asymmetry or add a premium. The premium you have to add to do something like wildfire risk is extremely high because it could be so enormous. So what they have done in California was we calculated what that would be. It would be 6 to 7% to add to it. That's enormous and probably not acceptable. So what they ended up doing instead, and I think it's an interesting solution, is they created a statewide fund that all the utilities in California contribute to. It's also in part paid for by customers, so it's part of the rates they pay. It's also in part paid for by the state of California. And then wherever that wildfire happens, that's where they then will end up having this entity, the money go. So those are sort of some of the things that I thought was very interesting. And I would be happy to address any kind of questions the audience might have. And I'm also happy to share the presentation. What I did provide in the presentation towards the end is I did provide a set of references for where I took most of this from and some of the regulatory practices.
Thank you, Bente. So thank you for this analysis of the cost of capital that you and Francesco have done very deep on the key issue to be addressed. And I would suggest now to pass the floor to the next presentation and then maybe find a time for questions if anyone wants to, from the audience, wants to ask questions on comments on the debate. So I will now leave the floor to Phil Cope, Senior Analyst of Moody's Investors, from the point of view of Moody's. So it's a rating approach to the infrastructures and regulated utilities. Ciao, Phil.
Thank you very much, Francesca, and good afternoon, ladies and gentlemen. In my presentation today, I'd like to explain how Moody's factors in things like physical climate risk, carbon transition, and water management in its rating approach to regulated utilities. I'll do this by walking you through Moody's approach to ESG considerations for regulated utilities, before turning to how changes to these regulatory frameworks are factored into our rating assessment. First, a bit of background on Moody's rated universe in these sectors. In Europe, Moody's rates 64 regulated energy networks and 24 water companies. Almost a fifth of these entities are owned by central or regional government bodies. These are the light blue bars in the bottom left-hand chart below. Their final rating may incorporate benefit for assumed shareholder support, which is why their average rating is slightly higher than that of the wider portfolio. Ratings in these sectors are predominantly positioned at investment grade, which using Moody's language means Baa3 or higher. And it's this robust credit quality that supports the significant funding requirements of a capital-intensive industry that we've heard about today. As you can see, the majority of these entities have a stable outlook, and this reflects the steady and predictable cash flows from these monopoly businesses that generally operate under well-established and predictable regulatory regimes. The Italian rated universe shown here covers Acea, AQP, CDP, Italgas, Snam, Terna, and 2i Reti. A2A and Hera are rated under our unregulated utilities methodology. Now turning back to ESG. Next slide, please. In recent years, Moody's has sought to communicate more consistently and transparently how ESG considerations are incorporated in its credit analysis. Regardless of whether we are looking at a regulated gas distribution company in Italy like Italgas, or a global healthcare company, we use a common set of categories under environmental, social, and governance that we believe reflects those considerations that are most material to credit. And these are shown on the schematic on your screens, with category definitions described in more detail in our ESG cross-sector rating methodology. There are linkages between ESG and our sector-specific rating methodologies. The sector-specific methodologies capture the factors and sub-factors which are relevant to most issuers in that rated universe most of the time. From the methodology scorecards, we get a scorecard indicated outcome, and this is one of several inputs into rating committee considerations. After rating committee have determined the credit rating, they also decide on an ESG credit impact score, which is also published. And a credit impact score reflects the impact of ESG on the rating. Specifically, it indicates the extent to which the credit rating would have been different in the absence of ESG issues. And this hopefully allows investors to place ESG in the context of other rating considerations. As you can see from the right-hand side of the slide, we use a 5-point scale for our ESG credit impact scores. Interestingly, and importantly, we only have one score, a CIS1, where ESG is credit positive for the rating, whilst we have 3 scores to reflect varying degrees of credit negative, moderate, high, or very high. One important point to stress, credit impact scores are not an opinion about a company's sustainability performance, nor the quality of its ESG disclosures. So now let's look at credit impact scores for European regulated utilities. Next slide, please. This slide is quite busy, so let's take each row at a time. As I've said, credit impact scores reflect the impact of ESG on the credit rating. You'll see from the top left-hand chart that the majority of European regulated utilities have a score of 2 or 3, i.e., their ratings are no different than what they would have been in the absence of ESG considerations. If we make this more general and look at Moody's wider rated universe, around 75% of all issuers are scored 2 or 3. Moody's also publishes issuer profile scores, and these show how our assessment of the issuer's exposure to environmental, social, governance risks or benefits that are important for credit risk, including relevant risk mitigants. And here, so these are the right-hand side charts, the vast majority of issuers have an issuer profile score of 3 for social, and the majority are 3 for environmental as well. So now just going a bit deeper, When we delve into the category scores of environmental, we see differences between the electricity, gas, and water sectors. The overall environmental issuer profile score is driven by the lowest of these category scores. So if we look at the first category, physical climate risk, this is looking at the current and future effects of climate change. As the majority of electricity network assets are typically above ground, they're susceptible to adverse weather, such as flooding, storms, and heat stress, as we've seen this summer in Southern Europe. But that weather is slightly less extreme in Europe than in many parts of the US, as we've heard about wildfires, but also for utilities operating in the northeast of the US, hurricanes are a real risk. As a result, we score European electricity networks 3, indicating moderately negative, rather than 4 or 5 for some of our US counterparts. On the water side, the water networks are exposed to climate change-related drought or flooding incidents, and therefore it's the majority of the water and electricity networks that are making up the band of 3 that you can see in the chart. If we now turn to carbon transition risk, here we're looking at a company's current positioning for carbon transition. To do this, we'd make an assessment of technology, market, and policy risks, as well as actions to mitigate those risks. Why is carbon transition not positive for electricity networks? Could make the case. After all, we've heard from Francesca that they're going to play a key role in facilitating the energy transition with connecting renewables, contributing to the decarbonisation of the transport sector, and in some jurisdictions of heat as well. The reason it's not positive for them is because of their large and ever-growing CapEx programs. Turner's latest 10-year network development plan envisages investments in excess of 21 billion over the 2023 to 32 period, a 17% increase compared to its 2021 to 2030 plan. And whilst that's a material increase, it's smaller than for many other European electricity transmission system operators. Indeed, annual capex levels of 10 to 20% of existing asset base are now common in our rated universe. This will increase the sector's leverage if it's majority debt financed. In addition, the higher financing requirements are happening at a time of higher interest rates, as we've heard in the Brattle presentations today. And this may not be fully reflected in the regulatory cost of debt allowances until the next regulatory reset. So this is going to place pressure not just on leverage, but also cash flow-based credit metrics, such as funds from operations to net debt, which is one of the metrics we focus on for European regulated utilities. In addition, these businesses are regulated monopolies, and so their larger scale, as measured by regulated asset base, is not materially improving their already strong business risk profile. Therefore, from a credit perspective, the energy transition is neutral to low for electricity networks. If I turn to the water sector, water management is becoming an ever-growing challenge. According to analysis by the UK government's Environmental Agency, the southeast of England will require additional supply of 1.8 billion litres a day by 2050. This is more than a third of current overall annual distribution input for the region. And this is to offset additional challenges from population growth and climate change, as well as increased drought resilience. So for the water sector, there's growing capex required to increase resilience, improve supply and demand management, and enhance strategic water resources. On the social side, so the second from the right on the top, and then the bottom row, the score of 3, moderately negative, reflects the risks common to all regulated utilities, that public concern over environmental, social, or affordability issues could lead to adverse regulatory or political intervention. Changing focus now. So if regulatory frameworks need to evolve to reflect the changing energy landscape and priorities, then how do them doing so impact our credit assessment? Next slide, please. In both our regulated water and regulated energy networks methodologies, the regulatory framework makes up 50% of the scorecard indicated outcome. On the left-hand side of this chart, I'm just showing you the scorecard for our regulated electric and gas networks. And what you can see here is that within that regulatory bucket, so the top two factors, the key consideration, which I've highlighted with the red box, is the stability and predictability of the regulatory regime, which carries a 15% weight. The more stable and predictable a regulatory regime is, the higher the debt carrying capacity at a given rating level. And this reflects the need for investor confidence that cash flows will remain stable and predictable. We see best regulatory practice as regulatory principles clearly defining risk allocation between companies on the one hand and customers on the other, with these principles being consistently applied. The high framework scores for energy networks in Europe, so the right-hand side table, reflect that there have been multiple periods of ex-ante regulation, dating back to the early to mid-2000s in most cases. And so a long track record has been established. And obviously, as many of you will know, Turner will be entering the 6th regulatory period for electricity transmission in January. We're also seeing other changes in Italy on the energy side. ARERA is moving to a TOTEX-based framework from 2024. However, the most significant regulatory framework changes are happening for gas networks in Europe. Next slide, please. We've briefly touched on concerns about stranded asset risk for gas networks. At Moody's, we see the level of carbon transition risk faced by gas networks varying within Europe. Some networks operate in jurisdictions that have ambitious decarbonisation agendas enshrined in law. In particular, they have an explicit date for a ban on new gas connections, which has either happened or will happen shortly, whilst in other jurisdictions, we have softer targets. And so under our ESG considerations, this has led us to giving gas networks either a score of 3, moderately negative, or 4, highly negative for carbon transition risk, and in turn, their environmental issuer profile scores. So this chart just shows for 4 countries what phase-out plans are, and these are 3 of the 4 countries, France, Great Britain, and Netherlands, are where we scored highly negative. However, regulation plays a really key role because it can help reduce stranded asset risk for gas networks. How? National regulatory authorities can and have proactively accelerated the recovery of investment costs. Last decade, this was mainly through shortening regulatory asset lives, as happened from April 2013 for gas distribution networks in Great Britain. But this decade, regulators have gone much further. For the start of the current regulatory period for gas networks, the Dutch and Swedish regulators have switched from real return to nominal return regimes, and this has boosted cash returns and therefore operating cash flows. The Dutch regulator, the ACM, has also applied depreciation scalars of between 1.2 and 1.3 times for gas distribution and gas transmission. In France, the CRIEP, the regulator, is looking at adopting similar measures to what the Dutch have done for gas networks in the regulatory periods that start in the middle of 2024. This acceleration of cash flows is NPV neutral. It doesn't increase the total volume of cash flows, but it does ensure a higher recovery of investment costs, while transportation volumes of the network in its current form are higher. And this hopefully explains why we have a more benign view of credit impact scores for gas networks than our environmental issuer profile scores in of themselves would suggest. And finally, as the most substantive changes to regulatory frameworks occur at the start of the new regulatory period, I wanted to leave you with a chart showing where we are in the regulatory cycle for European energy networks. Next slide, please. For energy networks, a host of new regulatory periods start in January 2024, with the next major wave in January 2026. So those dates also coinciding with Italy's for the energy networks, all in January 24, except gas distribution in January 2026. The regulatory cycle is also important for allowed returns. As we've heard in the presentation so far, over the last 18 months, we've seen higher financing costs for regulated utilities, and there's typically a lag until these higher costs are reflected in the allowed returns through updates to the allowed return methodologies used by the regulators. And this time lag reflects that in many jurisdictions, allowed returns are fixed for the duration of the regulatory period. Italy is one of the few jurisdictions where there is a provision for the WACC to be updated annually within period for energy networks. As most of you know on this call, this happens if the update of certain parameters would lead to an increase in the WACC of at least 50 basis points, as we expect to be the case for 2024 based on the higher interest rate environment. So this is credit positive for Italian energy networks because it will lead to higher allowed revenue and higher operating cash flows. Italy is not alone, however. Finland, Great Britain, the Netherlands, and Portugal are all examples of regime where there's annual indexation of allowed returns. Staying on allowed returns, one other interesting thing we've seen is that until very recently, there was a single allowed return for all investments, perhaps with some incentive adders like we see in the US. However, because of the sharp rise in financing costs, we're seeing regulators setting different returns depending on the timing of the commissioning of the asset. Austria and Germany are two examples of this. There's one return for investments done before the start of the regulatory period, and then another return for those investments undertaken during the regulatory period. And this is particularly important given the growing scale of investment requirements for the sector, and we see this as credit positive. Thank you very much for your time today. I'll now hand back to Francesca.
Here we are. Thank you, Phil, for your presentation. So before leaving the floor to Valerio Camerano, who will join us shortly, I will ask to the audience if there is some questions, or I can start with some question on the risk of stranded investments. So we have see the gas network can become stranded, but also I would say more generally all the carbon intensive assets as this risk. So I would ask to Bente, how should this investment should be considered in the WACC parameters, and then I will ask to Phil what are the main regulatory tool to taking account for these risks of standard cost. Thank you.
So, in my opinion, the primary tool for stranded risk is outside the WACC parameters. I think you should ideally try to depreciate the asset over the period of time where you think it's going to be in use. Having said that, it's clear that the risk of stranded assets is a risk parameter, and therefore you would want to go to things like the 67% tile or something like that of the WACC if you don't have all these methods in place. But I think primarily you would want to have all depreciation done during the period of time where you believe you would use your assets. So if you are going to terminate the natural gas network in 2030, say, it should be fully depreciated by that time, which might be an issue for affordability.
Okay, I think the problem is that once you have, I mean, at some point you realize you have to apply an accelerated depreciation, and this has a major effect on the allowed cost and ultimately on the tariff. And so you might want to elaborate a different tool for the regulated tariff in order to have to not to have a lump sum jump in the tariff from a year to another.
So one issue that has been done in the US is you do partly an accelerated depreciation, so it's not a complete depreciation of all assets over, say, the next 7 years, but you do accelerate a little bit, and then you rely heavily on the tool of securitization, where you spread out the cost over however long it normally would have been. So if it has normally would have been 20 years, you have that 20 years for customers are going to have to pay whatever that depreciation is, and that's done typically through a securitization. So that's another methodology to use there. Because the problem is, if you were going to reflect all of that risk in the WACC, you would have to increase it by so much that you again have this jump in rates, which you are trying to avoid. So you're probably going to have to see a mixture of tools, because that's probably what you have to go to keep rates from jumping too much, so to speak.
Sure. And so, Phil, based on your experience, what are the tools, the regulatory tools?
Thanks. So I guess we sort of touched on regulatory depreciation, the depreciation scalars, and the switch from real to nominal. So just maybe if I unpack the real to nominal in a bit more detail. So real returns is what you have in Italy, but that means that your RAB, your regulated asset base, will grow with inflation. And so a proportion of your cash flows are being deferred into the future, because with the growing RAB, you'll have higher depreciation and higher regulatory return. So this is a way, whilst you've got more customers using the network in its current form, of recovering more of those costs. So your RAB will decline a bit faster. But as Bente said, that the real challenge is the sort of balance of affordability. Last decade, we heard in the presentation about we had the low interest rates environment. So you had the falling WACC. So that gave regulators more flexibility because there was less upward pressure on bills. Now you've got the sort of the trilemma. You've got higher returns feeding through into tariffs. You need huge investments in the water and the energy sector and the electricity sector, which is putting upward pressure from the growth in the RAB. And then if you depreciate the assets over a shorter period, then you're also putting upward pressure on bills. So one of the things that we're sort of seeing a number of regulators also do is have funding pots for net zero, and have reopeners. So although the sort of key regulatory parameters are set, like the resolution published by ARERA, you can reopen it to see if there's a change in policy. And so that's what we have in the UK. We have a 450 million innovation allowance pot for things around hydrogen, but we also have the capability to reopen and reset regulatory priorities if there's a change in government policy. I guess what we're seeing in Italy, SNAM's 2022 to 2026 investment plan, there's 550 million being invested in biomethane. And I guess one thing that we would see when we look across Europe is the scope for hydrogen or biofuels really depends between countries, and there'll also be differences between distribution and transmission. There could be industrial clusters, but one of the things that a lot of these gas networks are doing is replacing the old iron mains, leak-prone pipe with polyethylene piping. So that would allow hydrogen or other gases to flow through the network, but there would still need to be material investments to cope in the sort of valves and compressors to cope with the different pressures involved. So it's a mix, and it's not homogeneous across Europe.
Yes, thank you. And you mentioned the change between current cost accounting RAB and historical cost accounting RAB, and the change, of course, accordingly to the real nominal WACC. But how you ensure in this change that there is the neutrality from the economic point of view during, the lifetime of the investments? Or, the question actually is, you have to ensure this neutrality. It is ensured somehow, or is secondary condition in a sense?
The RAB is sort of a measure of invested capital of the network. So if you're not indexing the RAB anymore, then it won't grow as quickly. So you're getting more cash flows now. It's not altering the total cash flows. What I can say, if I took the Netherlands example, which they moved from real to nominal returns, and they applied the depreciation scalar, we tightened our ratio guidance. So for a given credit rating level, we said we want to see higher funds from operations to net debt, because we were saying you're being given more cash flow now, but you'll get less in the future. We also have leverage guidance. So if your RAB is smaller, then the net debt to RAB, you need to use some of that additional cash to pay down debt. So that's how we adjusted the ratio guidance to reflect things.
Okay, so you basically anticipate or postpone it, like costs, allowed costs in the recognized for the tariff calculation.
Exactly.
Clear.
So I guess that one of the things for the rating agencies is we don't comment on whether policy is good or bad. Bente's got a view as to obviously what the appropriate cost of capital is. Ours is just more saying what's the credit implications of this.
I don't know if there is other questions or comments. Maybe even from Professor Greco. I mean, you are here for the conclusion, I know, maybe you want to anticipate or ask something.
I'm taking notes and I will keep for conclusions. I don't have specific questions, so I find it very interesting, and I will point out my considerations in the end if you.
Maybe if it's helpful if I just draw a distinction from how Moody sees the water and the energy sector. I talked about our score methodology scorecards and how important the stability and predictability of the regulatory regime is. I showed a AA score for Italy for the energy side. On the water side, MTI 3 started in January 2020 and will run to the end of this year. And as we've heard Francesca talk about, we're entering a new regulatory period. But 2014 is much more recent. That's less than 10 years ago, whereas many parts of Europe, it's been 20 or 30 years of ex-ante regulation. And it's one of the reasons that we score the regulatory framework for water BAA. And so that's kind of signaling that we have a more demanding credit rating, a more demanding ratio guidance for a given rating level than we would on the energy side. So we are very interested in see what happens in future periods. The other thing, probably are drawing distinctions between energy in Europe and energy elsewhere. On the gas side, there's quite a lot of concessions. So for some of these, there's a framework to be able to recover, like a terminal value payment. But most networks in Europe operate with an indefinite asset life. The sort of, as long as they fulfill the license conditions around operating performance, then they will continue to operate their assets. It's quite unusual, aside from in parts of Germany, the sort of concession framework for regulated utilities.
So can I ask you a question, Phil? I read in the news this morning that the UK is contemplating pushing out further their decarbonization goals. Do you have a view on how that would impact the ratings of the UK utilities?
I guess it's quite broad as to how wide you go. The one that's probably got the most traction in the UK is the ban on internal combustion engines being pushed back from 2030 to 2035. In reality, the UK is placing obligations on car manufacturers to sell a proportion of their cars that are electric, and otherwise they face about a €20,000 fine per car sold over that limit. And those limits are going to rise from about 20% or 22% in 2024 up to 80% in 2030. So just because that deadline has moved from 2030 to 2035, some of the car manufacturers are still going to carry on producing. On the electric side, actually, it's probably slightly positive for some of the networks because the government has talked about moving, or there's some of the planning constraints, and there's huge problems with delays on grid connections of accelerating the ability for them to get planning permissions. So that might mean actually higher capex in the short term. And then finally, there are greater incentives provided for heat pumps. So that might help some of the suppliers that are also moving into the heat pump space, because it may, the 50% growth in the grant received may encourage more people to take up heat pumps. So yes, it's a watering down, but it's a bit unclear as to whether that would actually see any impact for the businesses. It will definitely have an impact on the individuals though.
Thank you. There is one question, probably a comment.
No, actually, there is a question which is to Phil Cope. It is, I saw it was quite interesting, this issue about ESG, and I was just wondering if you see kind of trade-off in not having a clear definition of ESG, and because of course you have your methodology, but you know that this is a big deal of what it is actually this, and if this may have a negative impact also in terms of credit ratings of, for example, regulated utilities, but in general of other firms which are engaged in energy transition or other industries, or also fossil fuel industries. I was just wondering if you see some trouble there.
Really good question. There's certainly issues around the taxonomy, that there isn't a widely accepted definition. Some of the gas utilities are obviously being, like Snam is one of the biggest issuers of sort of transition bonds. But what counts as sustainability? Increasingly, we're seeing a number of companies adopt the UN's some or several of their sustainable development goals. So there is getting more conversions. I guess it will ultimately mean that there is probably slower convergence, and that may be helpful for some of those that are more exposed to some of the things that we've discussed, like carbon transition risk. But to be seen.
Thanks.
Who knows?
Thank you. Now I turn the floor over to Valerio Camerano, the Managing Director at Algebris Investments, for the investor's point of view. I think, Valerio, can you hear me?
Yeah.
Should be connected. Can you hear me, Valerio? I think he's trying to connect him back. Wonderful. So I now leave the floor to Valerio Camerano for the investor's point of view. He is the managing director of Algebris Investments. So Valerio, the floor is yours.
So thank you so much. I'm so sorry we couldn't join in time, but I actually was listening to you before, but I was not able to enter in the meeting. So thank you for waiting. I'm sorry for the delay, and I hope sorry for connecting later. And I hope I didn't miss anything, and I'm not going to repeat something that's been already discussed on the panel. Anyway, I'll try to be as concrete as possible. First of all, I think it's a sparkling time for investors because we're actually facing the biggest monetary adjustment in the last 40 years, which makes this period extremely new for the investors. Though we had actually deflationary period, stagflation, or raising interest rates in the past, but the combination of inflation, interest rates, and potentially recessions, in front of us, provides the investors a totally, different settings of measures and a variable to be interpreted, and makes, the environment slightly, sparkling, as I said at the beginning. The good news, from our perspective, is that the risk appetite from investor is still high. I mean, there's no big changes in the risk appetite, but clearly, the models, through which we are interpreting the reality and making our ideas regarding our investment are deeply changing. So the surrounding world is changing. So first of all, there's a general less availability of funds on the debt side, and also on the equity side. The fundraising are slightly delaying, and the debt market is slightly less available compared to the past. So globally, though the appetite for investments in the infrastructure arena still remains high, at the same time, the market availability of funds is less less interesting at the moment. At the same time, the levered IRR required for investing are clearly changing, given the cost of capital increase from the investors. At the same time, the risk, though the risk appetite is high, still at the same time the risk premium required for investing is changing, is adjusting, on a higher level. So if I need to place this reasoning within the investment markets, I would like to divide that into two big pieces. I mean, it's a simplification, but it helps the discussion. I would start from the private markets. So the private markets for private equity or venture capital, private debt, okay? And clearly, as I said at the beginning, the market is radically changing the modeling, so the way we interpret numbers, going forward. So the more difficult environment to provide financing is calling clearly for more selection in the investment. So investors will tend to be more selective, and will ask, given the higher levered IRR required from investors, and thus higher risk premium, the investors will be asking for more efficiency, more economy of scale, more outperformance, from the players, from the side of the players. So we do expect, the players being able to actually to offset, the negatives coming from the cost of capital, but cost of debt, cost of equity, and inflation, stagflation, all the other variables. So we do expect, operators to be more active on the economy of scales, on outperformance, on efficiency side, and so forth. And but clearly, the more selective approach from the investor side is going to potentially, provide or incentivize, some kinds of consolidations on the operator side. Something which, for example, is already happening on the optic fiber market, for example, because clearly the economy of scales you require to generate the efficiency differ. They're very different depending on the size of the players in the market. And since the regulatory framework typically works as a one size fits all the sides, we know that there's a big difference between big and medium and small competitors in the market. So the small competitors might find more difficulties in gaining efficiency or getting more de-risking activity under their activity. So we expect again a more active operator market. I think changes in regulation have been always the case in the last 20 years. So there's nothing new on that side, on that front. But clearly the present situation will require more active management of the variables from the operator side. And beyond the efficiency, we would expect some form of de-risking, especially in the execution of projects, which may help investors to balance the increasing risks on other variables, and potentially also a change in the support from regulators in some specific activities. Take for example what happened on the UK offshore wind market, and where that the tenders have been basically went desert. Nobody was actually applying on the tenders, and clearly, if you want to develop investments on that specific sector, regulators will have to rethink about their approach in the specific subject. So a combination of higher selection, less capital, more efficiency and consolidation required from the players, more de-risking in the execution of their businesses, and more regulation, selected support on the businesses will have to play a significant role to continue to generate the additional risk appetite from the investor side. Very, very, very generally speaking, on the private market. On the public market, so for companies that are floated and listed on the market, I think it's different. First of all, there's been a long time, there's a lot of friends in this industry, so we know very well each other, that the stocks of the utilities have been considered a proxy bond for a long time, and in Italy in particular, a proxy BTP. But clearly there was a relative preference for investing in utilities, given the risk return better position. So typically utilities had a higher return and lower risk compared to the BTP. But now, with the changing environment on the risk and returns also on the bond market, clearly the stocks are becoming less, on a relative terms, less interesting compared to the proxy bonds activity that they used to play in the past. So I think there's many positive things also on the positive sides. I mean, first of all, some of this stock went through a derating period, so they now can be bought at cheaper price, and that offers good opportunities for investors. At the same time, the relation between EV and RAB premiums offers good entry point, because at the moment, there's a tendency to decrease the EV RAB premiums in the market. At the same time, I think Phil was saying before it was cut off, that we could expect an increasing RAB as effect of inflation revaluation. So yes, I mean the answer is yes. We do expect some regulated asset base reinflated value, which is clearly a positive element. I think we need to understand better, what is the deflator utilized, because recently the deflator that the authorities are expected to use it doesn't equal CPI. So as long as there's going to be a big difference between the deflator used for RAB and the CPI, there's still a little bit of gap to be covered. But again, we do expect an increasing RAB due to the inflation effects, as we do expect allowed returns, increasing allowed returns as an effect of the regulated period. So there's a lot of good news, but clearly is a big one bad news. So the cost of capital is increasing, so the cost of debt is increasing, but also the cost of equity is increasing, because typically investors would flight to the stocks that offer higher yield, and to offer higher yield, you clearly need to increase your PE, so the cost of equity. So globally, the cost of equity, the cost of capital is going to increase. So the question is, I think the key question is, what is going to be the balance between the increasing cost of capital and the increased RAB and allowed returns effects? Who's going to win? Who's going to be the final effect? So The key question is, is I think this one. And the relative questions linked to that are clearly, will the capex be affordable, given this scenario, and will dividend be affordable, given that the market, especially on the private public side, will go for higher yield stocks preference. On the capex being affordable, I think we go back to the questions that somebody raised before between the net debt and RAB relationship. And I believe that the players that will be more disciplined and more able to keep the cost of debt under control, and also be more efficient in terms of operations, will be able to manage correctly the relationship between debt and RAB. And also in terms of the dividend policy, I think the market will tend to be a little bit more selective. The utilities that are going to gain more visibility, long-term, medium-term visibility on regulated cash flow, will be clearly benefiting from that. And again, also utilities with the stability in the regulatory framework will have more preference from investors. And in this case, I believe that those players will be able to deliver dividend policy in line with the expected levels of dividend yields required by the investors. And I think, in general terms, that pure regulated utility will be better positioned to deliver that value versus the mixed business regulated utilities. So I think, in concluding, the remarks, I think the framework is a little bit more compelling for players. Players will have to really steer, managerially, and from an operating point of view, and from an industrial point of view, more carefully their companies, because the investors will need to be more selective, and will require more higher IRR on their investments. So as a result of that, there's going to be a selection in the choice of investors, much more than in the past, much more what happened in the last 10 years or 15 years. This is becoming more and more a time of competitive allocation of capital for investors. So the bad news for managers, for operators, is that there's going to be more differences than in the past. And the past was mostly characterized by a sort of unanimous approach in managing the corporates. While I think the more troublesome underlying scenario we are facing today, will require more professional approach, more attention, more selection, more time dedicated to management of the companies in order to adjust and to attract interest from investors on a selective basis. So I think, as I said, my initial statement, the risk appetite from investors is still very high, but clearly the risk premium is going to change. When I say risk premium, I mean the risk premium required by investors, in their models to invest. And this is a changing environment. From one point of view, should be business as usual, but it is not business as usual. It's clearly a setting where the players will be playing their strategies, which is changing quite drastically, and is expected to remain such for some time, even if the inflation is expected to recover in the next years. So it's not going to be a free lunch period. I think in the coming years it's going to be a complex environment. But the good thing for the infrastructure business is that from a policy making point of view, from a consumer point of view, from an investor point of view, remains a cornerstone area of interest for many different stakeholders, and that's clearly a good premise, for operators that wants to develop their strategies within that space.
Thank you, Valerio, for your contribution. And your statements are very linked to the first section in which we have analyzed the WACC and the cost of capital in the regulated industries, which is of course very linked to the return that an investor asks to the investments. So thanks to all the speakers, I'm very, very thankful to have this pool of experts combining knowledge of regulated sectors, cost of capital calculation, and the investor's point of view in infrastructures and regulated sectors. And finally, I'd like to invite Luciano Greco, who is Associate Professor of Financial Science at University of Padova, to provide a summary of the conclusions of this seminar. So the floor is yours.
Thanks a lot. So I'm a public finance economist. So just to, so I thank you for the invitation, Utilitatis and Utilitatis. And I really congratulate for this discussion, which was very rich, and I really enjoyed the talks of the distinguished panelists. And so to me, it's the job of trying to put together things that are already linked very well. But and then, as usual for academics, is to try to give an outside view, and I hope I will not be too much academic, and then I will try to be very practical. So in all the what we heard from the panelists, we had, broadly speaking, we had this idea that regulation, as usual, we say, should reduce risk, not widen risk. So this is the general call that we have still in. It's an old-fashioned issue. So regulation should be predictable and should not add risks. And now, and this a particular thing is what is the impact on how we compute the cost of capital. And so there are, let's say, and that was very well explained by Francesco Passo and Bente Villadsen from Brattle. What is, well, the technicalities of computing and the experience around the world. So, and in particular, not Italy. Also, we had this very interesting overview of what happens around the world. So basically, there we have that the technicality matters, and but in this period, and I will come back to this in my personal consideration of what we heard today. In this period, we would like to have less history-related computation, more forward-looking computation. Now, this is a little bit troublesome because the future is more complex than before in a sense, and I will come back later. So the reason why the future is complex was also pointed out during the discussion from panelists is, well, we have a problem of climate change. So climate change has the impact of climate change on the way infrastructure function. So it's, in a sense, we need probably adaptation, for example, so new investments. So there are risks, so which relate to credit risk analysis that was spelled out by Phil Cope and Moody's, and this is understandable. But now we are realizing that it is a very important issue for, and particularly for utilities. And on the other side, we have that to face this challenge of climate change, we have to cope. We have, well, to implement some policies which, in a sense, which implemented energy transition. And here is another problem, because energy transition brings with it stranded assets issue, which was discussed, and this has impacts on how we compute. So this, and in the last talk by Valerio Camerano from Algebris, we had this view that past and future are different, and at least if we consider past last 40 years and future next 40 years, for example. So I start from here just to try to add some comments and considerations. So the first is that what we expect from policy making, and particularly from regulation in this specific framework, thinking about all the things that we were very clearly discussed today, and particularly about the incentive to have investor coming to this sector, investing and doing the right thing. So I would say that we would like to have kind of forward guidance in regulation. So the point is that we cannot have static regulation because we have to face energy transition and climate change. And these two big things, which is the title of this webinar, is imply deep structural uncertainty. So it is technically impossible to compute ex ante or so to predict everything which is going to happen next even 10, 15 years from now. So the UK mill wind, the failure of the auction in UK will mean the is an example of this. No one would imagine this. Let's say, no, I would say at least laymen like men would not imagine this 2 years ago. Okay, so now, and in principle, we need more wind powered electric energy in future, but in the middle of this transition, we have that this is a sector which becomes more risky for many reasons that I will not spell now. So what happens is that we need that regulation adapt to this unpredictable events, or at least in the timing of when they happen, they are unpredictable. Then we may add other things which are war and inflation and other things, but just stick to energy transition and climate change. I think it is enough to have a picture of how unpredictable is the regulatory framework in future years. So why I'm stressing this point? Because I think that this means that we have to adapt to a world where regulation has to change more often. And now this implies a problem in terms of predictability. Okay, so when I say forward guidance of regulation, I mean that we should ask regulators, and I think the industry in Europe at least, or in Italy, should ask regulators to set down some rules of how to change the rules. Okay, and this, for example, we need some renegotiation for sure during the period between when we had this discussion of regulating periods, but it is too much to wait for the end of the regulating period, and so we need to change. And this kind of renegotiation is part of it becomes very important also to deal with problems like, for example, were discussed very well. So is it enough to use inflation as a mechanism to solve the problem of utilities? Well, yes and no, because then we have the problem of bill payers, who then we may ask the government to intervene there. So again, and this we see that it is happening, and then of course government can intervene with fiscal resources, but sometimes we try to intervene on regulators and so on and so forth. So I think that the idea that solving the problems of windmills that we saw in UK, solving the problems of how to strike a balance between the problem of consumers, so looking at increasing prices, and of course utility managers that have the problem of coping with all the discussion of stranded assets and so on and so forth. I think that the intervention should be more we should have a regulator which intervenes more often. So it is important to understand how it should intervene. So the rules of the game of renegotiation in some sense. We had some examples that I will not go back to discuss, and I think that so just to look at what would mean this, for example, in terms of computation of the cost of capital. So of course, we would like to have the most predictable way of computing the cost of capital. It is backward looking, right? I lay down a rule, but then we saw that it is exactly what we don't want, because backward looking means a world which is no more there, or it brings to some, let's say, mistakes depending on the kind of measure that you use, that was very well spelled out. So one thing that we can use, something that we use, for example, in macroeconomic policy, in a monetary policy, we can ask to the sector people, so to a panel of people, to what do they expect for the future, and try to bring this thing in the process of computing the cost of capital. Of course, this is an academic proposal, so I mean, I understand that there are many problems in implementing this, but it is not impossible. And I think that this should be considered. These are other ways of dealing with how we deal with future. It's quite important. So in the academic discussion, there is this idea that we should have that the social discount rate to evaluate projects, infrastructure projects in particular in utilities, but in general, should be decreasing because of climate change. And there are some computations. And so I think that we should be more creative in how to translate this academic suggestion, which is very well grounded grounded in the literature, and try to bring to the table of the policymaker, of the regulator. And I think this is the challenge of people who work in utilities, who work on credit ratings, is very much to explain how to do this kind of things. I think that there could be many. It's a challenge. I mean, it's not something easy to do, but I think it should be done, because otherwise we will stuck with some cost of capital. It is always something that it is either too high or too low, and there is no way of dealing it ex ante. Another issue, and this is the last point, that it was in the question that I asked to, terrible question that I asked to Phil Cope. It's about ESG. I mean, I think that there is a risk there. And this is my impression. So I think that it is important to have a rating on this, but currently we are in a world where we may have an additional source of deep uncertainty. What happens if this difference in languages translate into a bubble of green finance? We don't know. So I think that intervening there, trying to, and here I think that the rating agencies have the experience of how to do this, but I think that it is very important to introduce some kind of standardization there, because otherwise there we may have another source of, let's say, asymmetric information, another source of market frictions on financial markets. So different institutions measure in different ways the ESG credentials or ratings of different. So, and I think in sectors like utilities, this is a crucial, is very important. So we cannot afford to just wait and see. And so this is another sector where I think that it is not just for utilities, but I think that for utility sector is very important to understand how we measure this kind of ESG ratings. And basically, that's it. Again, I really congratulate Utilitatis for this interesting talk, and I hope that my remarks were at least partly useful. Thanks.
So thank you very much, everyone. Special thanks to the speakers and to all the audience. And thanks for all the contributions. Bye.
Bye.
Thank you. My pleasure.
Thank you.